Hello everyone, and today we are going to discuss deflation versus inflation debate which currently going on actively in US. On the deflation side, you will have people like Dave Rosenberg and Dr. Lacey Hunt. On inflation side, you will have people like Peter Schiff and Russell Napier. Let's start first with inflation arguments. So what inflation is say at first that deficits are extremely high. You can see it on the chart. For the past 20 years it goes parabolic. Where does the government take money if they spend more than they earn through tax revenue? Obviously it should come from somewhere. It should be borrowed or printed into existence. And inflationists say that less and less governments from around the world wants to borrow money to US, and therefore more and more of those money are printed. If we go to the next slide, it's an interest rate, and you can see in the 1970s during the inflation spike in US, Federal Reserve Chairman Paul Volcker at that time increased interest rates almost to 20% in order to break the back of the inflation. It was extremely painful process for US, but they were able to manage that. Since then, Federal Reserve new chairmen were more and more dovish, and interest rates were going down, and every time there would be a crisis in US, like global financial crisis with real estate in US in 2007, you can see that government reduced dramatically the interest rates. And they continue to do that every time they see at least slightest disturbance on the market. And what this chart might remind you is it's a pulse of a dying person. On the next slide, you can see M2 money supply. M2 money supply had increased in the past 20 years, and in the past year 2020 it went parabolic. Where all those money came from, and if you consider current narrative, just increase of money supply does not produce inflation. It's money supply together with velocity. How often does those money change hands in the economy? That's what produces inflation. But if you look at this money supply chart only, you see that money supply went up dramatically. In the next slide you will see a Federal Reserve balance sheet. And if you compare the two slides, increase in money supply and Federal Reserve balance sheet, you will see that for the past 40 years there were very little correlation between the money supply increase and Federal Reserve balance sheet, except for 2020. As George Gammon mentioned pointed out in his YouTube channel, that this reflects how Federal Reserve handled this situation, that money actually did not stay in the banking system but went to the public. So the spike in M2 money supply 2020 corresponds and correlates with the increase in the Federal Reserve balance sheet in 2020. It's a very interesting factor. Normally, when Federal Reserve creates additional reserves, it does not go into real economy. Money supply expansion is mainly a function of banks. When banks issue credit, money supply expands. And therefore, there should supposed to be no correlation between Federal Reserve asset balance sheet and M2 money supply. But that's what is very important to point out, that 2020 was an exception, and you can see correlation between those two charts. Let's go now to deflationist main arguments. The first deflationist main argument is total public debt. Current United States debt is around 28 trillion US dollars, and you can see on the chart it's actually goes very steep, especially after global financial crisis in 2007. So what that does, it does the opposite from money expansion under the credit issuance of private banks. When private banks issue credit, money supply expands because money are created when credit is issued. When someone defaults on its debt, it contracts. Default on debt is a contraction of money. High level of debt strangulate economy and businesses because you need to pay interest on this debt. And it impedes active development and active growth of the private sector. It means the higher the debt, lower the year-over-year growth of the private sector. And if you combine low growth with low confidence and credit defaults, then it means people spend less, money supply contracts. It means goods on the market cost less because there are less demand, and it's a self-perpetuating process. So people start to buy less because they expect that next day prices will go even lower, so they start to save money. They see defaults in the banks and banks tremble, so people are afraid and they start to stick their money under the mattress, and all economy goes into depression like in US in 1930s. Another deflation argument is productivity. In the past, year over year, productivity risen by 4%. So Dr. Lacey Hunt and David Rosenberg say if productivity rises, it means cost of goods compared to the hours worked to produce those goods rises. It's a deflationary factor in the economy. So now let's go to my personal opinion. What do I think between inflation and deflation arguments? So let's first have a look on a CPI. A CPI consists of all those categories. The one category I'm missing here, and I see high level of inflation in the past 20 years in US, are the financial assets. Stock market is extremely overvalued, and you can I discussed this in other of my videos, which makes me question CPI as a category in general. So let's see the critique of CPI. I put it here on the screen. The main critique of CPI that it's not just reflects the price. It does not tell you how much would price increase for the past 60, 70, 100 years. It will consider the quality as a new methodology of CPI. And I will explain you in the next slides what I mean with that. So if you take the official CPI numbers, inflation numbers from 1960 to 1921, you would see that the prices increased by round about 9 times. So $1 in 1960 had a more purchasing power than US dollar in 2021 by a factor of 9. If I take data from Morris County Library, where they show the prices from 1959, a newspaper in 1959 costed 7 cents. Newspaper in 2021 cost $2. It is a 28 times price increase from 1960 to 2021, compared to 9 times measured by official CPI. So official CPI will tell you that newspaper in 1960 was in black and white, it was not color, and maybe some other quality characteristics of the paper which now are different than in 1960. But does it really make sense that newspaper factually increased in the price by 28 times and official CPI gives it only 9 times? So it seemed to me the CPI is skewed in order to underappreciate the inflation. Now let's go to productivity argument. I also have a question to that. Productivity is measured by value of output of the goods produced by the number of hours used in order to produce this product. But what is behind those figures? So we know that it's very difficult to calculate output because of inventories and other factors. So normally economists take GDP or consumption. So they use consumption as a reliable numbers because output is difficult to measure. Consumption also can be expressed as GDP, gross domestic product. So if I go into productivity and try to dig a little bit deeper, it's a paper from Bureau of Labor and Statistics in US in 2021. The numbers will show you that productivity increased mainly in non-farm business, it's decreased in manufacturing for non-durable goods, and almost the same for durable manufacturing. So the question again, what is behind the non-farm business and business where productivity grew? If I take GDP main contributors, where people spend the most money, is the finance, insurance, real estate, rental and leasing, and the second category, professionals. Professionals include web developers, accountants, lawyers. So if I believe in this productivity number, it means the cost of goods increased and the number of hours required to produce those goods and services was reduced. Just looking at US economy currently actively stimulated by Federal Reserve and therefore high increase in the value of assets like stocks, so financial products. We know that on derivative markets they're around 500 trillion US dollars, and big portion of that had been paid for by loans and were bought on the margin. So it's a leveraged money, it's a money borrowed in the bank. So therefore I question myself, does the real output grew because they produce some better services and because of those financial products or services actually more valuable? Or it's because of this phony economy where Federal Reserve prints a lot of money. At the same time, US dollar does not lose value because it's a world reserve currency and therefore productivity grows. I cannot answer this question, and if anyone knows better and can point out some source of information I can learn from, I would highly appreciate that. But if I just look at disparity in the income in the United States for the past 35 years, I see that the top 10% had highly increased their income and the bottom 90% declined. So for me, the inflation created after 1971, when the US went from gold reserve, was by Cantillon effect trickling down to certain institutions and produced high level of speculation as well as bubble in the financial market. Therefore, I'm questioning productivity as well. And therefore, my conclusion, just based on the facts I looked into, that inflation is the most probable scenario. Whether it will be stagflation or hyperinflation, I don't think anyone can answer that because there is a human factor involved in every decision. Politicians decide at the end what do they want to do. Do they want to continue stimulating the economy they did for the past 20 years? Or they actually wake up to the common sense and go austerity path? Let me know what do you think. Thank you for watching this video and I will see you in the next one. Bye bye.